John, thank you so much for joining us today.
Hey, Elijah. Good to talk to you again.
All right. Now, you recently released on your website, and also you were on a podcast with usawatchdog.com, and you were talking about emerging market currencies and how a lot of the currencies are collapsing right now in Venezuela, Argentina, Turkey, Pakistan, and the list just keeps going on. Can you share with our viewers a little bit about what's happening right now and what is causing all of this turmoil in the currency markets?
Well, there's always a background rate of small country currency crises because, there's 150 countries out there right now. So at any given time, several of them are screwing up their currency, borrowing too much money, creating too much currency, having a crisis, lopping some zeros off and moving on. That's normal. But there are times when a greater number of countries get into trouble. And when that happens, there's usually a reason for it. And in this case, it's external dollar debt. Basically, what happened was a few years ago, the U.S. dollar was going down relative to currencies of countries like Brazil and Argentina and Turkey, among many others, and China. So it looked like a good deal for those guys to borrow dollars at, let's say, 2%, just to pull a number out of generally thin air, and reinvest that money either in infrastructure projects at home or in their own country's bonds that yield 6 or 7%. So you make a nice carry there. And if your currency continues to go up versus the dollar, you win both ways. There's potential fortunes to be made by doing something like that when currency trends are in the right direction. Well, it worked for them for a while, but then the dollar started to go back up, and U.S. interest rates started to go back up. So what that meant for these guys is that these carry trades are no longer profitable. And some of these guys have massive, in relation to their GDP, amounts of external dollar debt. And that has spooked the market. So everybody's selling off their currency. And that's making it harder and harder to manage this external dollar debt, which is making everyone sell off the currency even more aggressively, and so on, until you get a kind of a death spiral. Add in the whole trade war environment that we've got going on now, where the U.S. is imposing sanctions on pretty much anybody who crosses President Trump, which, for instance, with Turkey, has added to the crisis environment there and made things even worse for these guys. Now, ordinarily, when an emerging market has a currency crisis, it's not a huge deal because it's in the context of everybody else being reasonably healthy. But today, that's not the case. The rest of the world is grossly over indebted, and the big Western banks, especially European banks, but also U.S. banks, are the ones who lent the money to these emerging markets who now can't pay back their loans or who are in danger of not being able to pay back their loans. So the crisis, to use the terminology that's popular now, it began at the periphery and it's moving into the core. For instance, Spanish banks, to take just one example, are on the hook for about 5% of Spanish GDP just to Turkey. So this is a big deal. This is a potentially systemically dangerous crisis that we've got going now. And it's anybody's guess how it plays out, because there are probably more emerging market countries with external dollar debt that's going to blow up on them. So we're not done yet. And it's not clear how we get out of this, because the old tools, for instance, just bailing out all the big Western banks for hundreds of billions or even trillions of dollars in some cases, has worked in the past, but at the cost of ever increasing amounts of fiat currency out in the world. And at some point, that's not going to work anymore, because people are going to figure out that we're creating huge amounts of new currency, taking on huge amounts of new government debt in order to bail out private sector actors who probably should have been just left to fail in an actual, real functioning capitalist system. And that's going to put pressure on the fiat currencies like the euro and the yen and the dollar, and take away the tools that those central banks have to manage their own economies in the global system. So at some point, a crisis from the periphery will have that effect. And whether it's this crisis, whether it's today's emerging market crisis, remains to be seen. But this one has the potential to do that. And if it doesn't, there are plenty more waiting in the wings. Something's going to happen in the not too distant future to make it clear to everybody that the current fiat currency, fractional reserve banking, massive government spending system that we've got now is unworkable. When that happens, well, we can talk about it in a minute, when that happens in terms of precious metals and other kinds of investments that you might want to be in. But suffice it to say now that we're in danger of creating a crisis that spreads across the world, and this could be the catalyst for it.
Definitely. And how fast could something like this have an impact on the U.S. dollar?
Well, we're on internet time now. So something that happens in one part of the world is quickly disseminated to other parts of the world. The financial system, being as leveraged as it is in the U.S. and the rest of the developed world, is always on the verge of some kind of a crisis just because we borrowed way too much money. Nothing mystical, magical about this. When you borrow too much money as an individual, you're one blown car engine or leaky roof or illness away from a financial crisis. Well, the developed world is in that situation now where one thing, a war somewhere or one big company going bust or Brazil not being able to pay back its dollar-denominated debt, it is sufficient to spook everybody into something much more serious. And when that happens, it'll happen, well, from our point of view in the U.S., it's especially scary because it'll probably happen overnight. Something will happen in one part of the world that spreads to the Asian markets or the European markets, and then we wake up to a crisis without the ability to do anything about it because our stocks are gapping down and our bond funds won't let us redeem our investment. And interest rates are spiking, which is causing mortgage rates to spike, which is causing home prices to fall. All that stuff can happen in a very short period of time. So the only solution for people in this time zone and in a developed country with a lot of capital at stake is to set it up now so you're prepared for that. And then you can sleep well knowing that if the big crisis that's looming out there at some point in the future happens tonight, you're pretty much prepared for it. And that's really all you can do because you can't know anything about the timing and you can't know about the direction that it comes, whether it starts in Asia and works its way over here or starts here and works its way over there. We can't know that. But we, just by looking at the numbers, can be reasonably certain that something crazy is out there starting at some point in some place, and it'll come back to haunt us, and it'll affect our financial lives by making financial assets like stocks of banks and government bonds and bank accounts and bank CDs and money market funds less valuable because it'll affect the currency markets. So knowing that, we kind of have a roadmap for setting things up, but we can't know anything about the timing because none of that is predictable in any way. So all we can do is just get set up and then be prepared for when it does happen.
Now, speaking of precious metals and ways for people to protect themselves against this crisis, we recently saw just in mid-August of this month, we saw gold and silver go down significantly to lows we haven't seen, it seems like, since for silver, the beginning of 2016, and for gold, late 2016. Now, this might be a great opportunity. We can't give financial advice on this channel, but this might be a great opportunity. Some people are saying that these are probably the lowest gold and silver are going to go. And you had on your website some information from the Commitment of Traders report that might indicate that we're going to see a spike in gold and silver going forward.
Well, the paper markets for gold and silver, in other words, the markets where futures contracts are traded for delivery of gold and silver tend to dictate the price in our financialized world right now. And the structure of the futures market, because of that, becomes a pretty good indicator of the tenor of the gold and silver market for the following 6 or so months. And sometimes the paper market gets way out of whack. And that tends to precede big price moves in one direction or the other. And what's happened lately is that the speculators in the market, those are the people who trade on emotion and momentum, have gotten more and more nervous. And they got extremely nervous and pessimistic after gold and silver, like you said, tanked. You know, we kind of had a capitulation there when the price of those metals really plunged. And that led the speculators to cut back on their long positions, load up on short positions, in other words, betting that the trend will continue, to the point that they're net short. In other words, their shorts exceed their longs. That's highly unusual for those guys. In fact, I saw a chart the other day that said the last time that happened was 1999, you know, before we embarked on this huge long run for gold and silver and the mining stocks that are related to them. So we're at a point in the paper market now where it's screaming buy, because the speculators are so short that even a small uptick in price could lead a lot of them to panic in the other direction, close out their shorts by buying precious metals, in other words, by going long precious metals, and that pushes up the price even further, which flushes out more shorts. So you get a classic short squeeze. And I'm not saying that's going to happen necessarily, but the structure of the market is such that now it's a very real possibility. So that's one favorable thing for gold and silver. At the same time, you've got seasonality now working in its favor. There's an old saying in precious metals, sell in May and go away, because the summer is usually the doldrums, when there isn't a lot of buying from Asia to propel physical gold and silver prices out there. But then as autumn comes around, the Asians start buying again. And usually in August, a lot of people start front-running that process. So August is a pretty good month for precious metals prices. And then that momentum continues with Asian buying through like February or March. So we've got a really favorable structure in the paper markets and positive seasonality coming online now at a time when gold and silver are way down. So you add it all up, and nothing is guaranteed ever in any financial market, but the structure of the precious metals market is pretty favorable right now. This is, if you're using history as a guide, a decent time to be adding to, for instance, your stack of silver coins, or your portfolio of high-quality mining stocks, or your gold bullion stored overseas. You know, this is an okay time for it. Now, the longer-term fundamentals for precious metals are phenomenally good. You know, I'm talking about the timing of the next 6 months so far. But if you look at the next 10 years, gold and silver are maybe the very best things to own, because the fiat currencies of the world are being so aggressively overproduced and therefore inflated away by the world's governments. There isn't a major government out there that isn't taking on excessive amounts of debt one way or another. And there isn't a major country private sector that isn't over-leveraging itself right now. And historically, of course, we've never really seen this kind of history, because usually when countries screw up their finances and then have to devalue their currencies, it's one country in the context of most other countries doing okay. In a sound money world, in other words, this is not a sound money world now. We've got every major country running fiat currencies in which they basically borrow as much money as they want, and they create as much new currency as they need to cover their borrowing, which is historically what leads to currency crises. But this time around, it's everybody. So I think that the fundamentals for gold and silver, which are forms of money that can't be inflated away by governments, and therefore are places where people hide out when fiat currencies blow up, are great. If you look at the amount of fiat currency that's out there, compare it to the amount of gold and silver in the financial system right now, and there really is no comparison. There's an immense and growing pile of fiat currencies versus a relatively small and very slow growing pile of precious metals. So if even 3% of global investable capital decides it wants to hide out in precious metals, it will send them to the moon. They will just rocket, because there just aren't very many gold bars or silver coins out there right now, and the supply isn't growing very quickly. But there's a ton of paper that could flow into them. So when that happens, you get a Bitcoin-like parabolic run. And again, no way to know what the timing is of this. It could be next week, could be 5 years from now. But the conditions have been created in which something like that has become a near certainty. And again, if you're trying to organize your finances to protect yourself from what you see happening, the way you do that, or one way that you do that, is to just buy a bunch of precious metals, put them in a very safe place, and then with your speculative capital, buy some really high quality gold and silver miners, and then just let them run. They might do terribly for a couple of years, but within 10 years, probably within 5 years, they will make you a lot of money, or at least preserve your purchasing power. So they'll protect you. And then you can relax knowing that you've got insurance. You're protected against the worst case scenario, and you can get on with your life. And that's really all you can say about money. If you're organizing your finances, the idea that you can make a fortune in 3 years is really far-fetched. People do it, but it's almost a random process. But you can protect yourself so that you can sleep at night, and that what you've earned will still be there when your family needs it. And that's what precious metals do for you. They are an insurance policy that preserves wealth over long periods of time. And now, perhaps more than ever in human history, they're going to get a chance to show off and show how they can really do that in a very chaotic world.
Now, you did say in one of the recent articles you wrote that silver looks like the fundamentals for silver are even better than gold, and also the junior mining stocks are even better than silver. Can you expand on why? Yeah.
Well, silver is a lot smaller market than gold, which means that hypothetical 3% of global investable capital flowing into precious metals, if it's evenly divided between gold and silver, it will make silver move much, much more dramatically than gold. And that's always the way it's been. Silver tends to be more volatile than gold. It goes up more than gold, and it goes down more than gold. And right now, it's extremely cheap relative to gold. The gold to silver ratio is something like 80. In other words, it takes 80 ounces of silver to buy an ounce of gold. And that's at the high end of the historical range. And every time it's been in that range in the past, there's been a gold bull market and a radical silver bull market, where silver went up dramatically more than gold. So we're back there again. And we should expect, if gold rises, which it ought to over the intermediate term, that silver should rise more. Now, mining stocks are basically silver on steroids, situationally. They're thinly traded, mostly very small capitalization, with not a whole lot of institutional following. So people don't know about, for instance, exploration companies or junior producers or anything. So they tend to be very cheap in bear markets. And they've had a horrific bear market lately. They've really gotten whacked. So there are a ton of 10-baggers out there, little mining stocks that are just going to rocket when the time comes. And in fact, one just happened last week. There's a exploration company called Great Bear Resources that was 39 cents a share. Then they reported a good find. In other words, they did some drilling. They found quite a bit of gold in the drilling, unexpectedly large amount, and the stock tripled in 3 days. It went from Well, it was 39 cents at the very bottom. So it went from 39 cents up to $1.40, give or take. And that's the kind of thing that we'll see a lot of going forward, because there are a lot of well-managed junior miners with decent resources that would be attractive to a big miner for buyout, or that would produce a working mining company with positive cash flow for the long term. And nobody's paying attention. So when people start looking around, they see Great Bear and think, who's next? And they'll find a long list of companies that are potentially next, and then they'll pile into them. And then momentum players will come in who don't even care about gold and silver or gold and silver miners, but they see something moving, and they assume the trend is going to continue based on their charts. So they pile in, and then these things really take off. And they're so thinly traded now, and they're so small, that 10 times today's price is not an outrageous target. You go back through the history of gold and silver mining, you find a lot of things like that. I actually had one. My stock that got away is something called Glamis Gold that I, back in the 2000s, bought some at $1.50. And then it went to $3, and I sold it because I thought it was a genius. I doubled my money. But in the next few years, it went to 48 or something like that before Goldcorp bought them out. So, I missed a 10-bagger there and watched impotently while the thing just went up and up and up. There are going to be many things like that, many junior miners that behave that way in the coming decade. So you can't buy random junior miners. Don't ever do that, because 90% of them, as Rick Rule likes to say, 90% of them cease to exist. And all the profit in the junior mining sector is made by a handful, 10% or fewer companies that work out. So to play junior miners, you need a good source of information. And there are a few newsletters out there. I rely heavily on Jay Taylor's newsletter, but there are some other good ones too. That are published by people who spend their days looking at these little companies and separating the wheat from the chaff. And you need a source of information like that if you're going to play in this market. Now, with the bigger gold miners, it's less stressful, less profitable, but still very profitable potentially in this kind of a move. You got a lot of big miners out there like Goldcorp and Agnico Eagle, and then you've got ETFs and other kinds of mutual funds that own big portfolios of these stocks, like GDX or GDXJ, and they will go up dramatically, not nearly as much as a well-chosen junior, but they'll still go up 3 or 4 or 5 times when the bull market in precious metals really gets going, because they're also very cheap. So you can make a diversified bet on gold or silver miners with one of these ETFs or mutual funds and be protected from the failure of any individual miner by diversification. And I think most people should do that. You don't really have to pick your own stocks. Just get a mutual fund that's managed by a reputable manager and let them do the stock picking for you, but just